Hey everybody, welcome to the podcast. It's not really a full featured podcast. We're not going to go through a bunch of items. I did just want to touch on oil. Oil is up a lot today. We're up over 40. We were up over 40 yesterday, and we're up over 40 and sticking, and a little further today after Russia and Saudi Arabia apparently are agreeing on an output freeze, and it's interesting. The market's going up on that, and as you can see on USO, we're up about almost 3.6, 3.7% on the ETF that trades like oil. And this is almost a retread of a headline we got 2 months ago, but the market's taking it positively, and we're moving higher. And so you're seeing oil. You can see here it had that breakout, kind of a almost inverse head and shoulders back here. We had, of course, January, then we had the February low, and then there you go. And so we've had that movement, and then it's been kind of off to the races. Now, there's been some talk today that energy stocks are back above their 200-day moving average, which is this red line for the first time going way back. I think it's been over a year at least, probably something like 400 days, something like that. So, but as you can see here from this picture, it's not out of the woods just yet. You can see this downtrend that kind of developed, and now we're right back up to it again. And so we really need to, and I'll take this off and zoom in a little bit, we really need to still do a little bit of work. So kind of maybe the line that I would look at is right in here. I think if we were to break out here, maybe come back down to this area one more time, and then could we go higher and start seeing something like, need to be careful of this arrow. You start thinking that I'm saying we're going to get $85 oil next week. but if we could break out a little bit more, pull back, and then come, now you have more of a defined, maybe a real big, inverse head and shoulders there. That would be bullish in the long term. So, but it is positive. Of course, you're seeing those big companies move up about 3%. You're seeing the XOP, which is the exploration and production companies, the E&P companies, that's up about 6% today. And this is actually our largest holding in our aggressive strategy, and very, very volatile. It's been a big move, but that boost, what happened this morning with the stock market was you saw in fact, let me switch over to the S&P 500. You saw really a pretty quick move down. You can see, let me switch it to 1 minute, but we had a pretty quick move down right after the open, and we were right about here. It gapped up, then it faded, and this little move right here, that right there was when that news came out, and it's really been up ever since. And so no question, yes, oil and stocks have been not moving exactly the same since, for this year as much as they were last year. But no doubt, better oil, you're still seeing a bounce in stocks when that happens. So as we speak, and we still have about a couple hours to go before the close, but as we speak, the Dow Jones is up about 160 points. So let's take a look real quick. We looked at oil, but let's take a look real quick at the S&P. It still has some work to do. You can see this is the obvious picture most are looking at, and of course the bears would expect it to go down here. The bulls would hope for maybe just a blast off and go straight on through. I think the longer it does go without pulling back is bullish, and I think once we do break above that, you're going to get fresh new buying coming in. So, I'd be careful about throwing a bunch of money in here at this level, but I would also be careful about going out and just selling everything because it's at the top of the range. There's going to be one of these times that maybe does break through. So I wouldn't be throwing a bunch of money at the market if you're sitting there, 100% cash and you haven't been invested for the whole year. Would I buy some right now? Yeah, I'd have some in the market right now, even at these levels. But if I'm, sitting there with 90% invested and I'm waiting on that other 10%, would this be the level I put the other 10% in? Probably not. I'd still keep a pretty balanced approach. But I do think the whole commodity complex, the foreign stocks going up, is good, and I think that's what we've been looking for. You know, when you look at things like the emerging markets, definitely continue to improve. When you look at even EFA, the developed markets, improving, but and we're getting some of these reports, economic reports, that are a little better lately. Now, you have been seeing a lot of GDP revisions down and earnings revisions down. So I do think there's a lot of that baked in, and I think there's still more room to surprise on the upside than the downside. So if we get an earnings season here, and we had Alcoa last couple nights, but if we have earnings beat, there is expectation here that things are going to be pretty bad this quarter, or for last quarter. Could we see the stock market ramp up and go to new highs? I think it's highly possible to do that. Again, that does not mean, though, and I want to be clear about this, that doesn't mean we're in a new bull market and everything's okay again. We need to see some more broadening out. We need to see some real demand here and the supply continue to drop. We haven't really seen that. It's been a good rally from February 11th, but we haven't seen the intensity that I'd like to see. So it still feels like more of a trading range than anything, but what I would look for is a continued rotation. Is there going to be some things working now that haven't worked in the past? You know, things like gold are working, things like foreign stocks are working, some of the commodity stocks are working. That's something new in 2016 that we didn't see in 2015. So I'd like to see that rotation continue. But right now, you know, all eyes are on the S&P at these levels. So watch for a breakout, maybe somewhere, let's just for grins call it 2100. That would be a level that maybe you'd start to see some more money come in the market. But definitely the big news of the day today has been the energy stocks back above their 200-day moving average for the first time in well over a year. But again, as I mentioned, this downtrend is still in play. In fact, let me show you a weekly picture here, and you can see what I'm talking about. So this, you know, XLE, which is the basket of kind of the broadest basket of energy stocks, you know, got up to about $101, got down to 50. So it was cut in half in about a year and a half. And yes, it's rallied significantly. You're talking about 25% from the bottom, but we're still in this downtrend. So I think we have a little more work to do. I'd like to see it break out, maybe pull back a little bit, and then maybe we can get sustained moves higher, or at least more longer-term stabilization. Remember, if we fast forward 6 months from now and we're still sitting at these levels, that's not the worst thing in the world either. We just need to stop this downtrend. Unless you're short. If you're short, you want a downtrend, right? You're betting against it. So, but we actually own XOP in our aggressive, and we also own some master limited partnerships in our income strategy, which we've owned for a while now. We've averaged into it at least 2 or 3 times this year, and continuing to collect double-digit income on that. So that's been pretty good for us. That's about it, guys. Just wanted to give you that update on really energy and oil prices. All right, take care. Don't forget Eggers Report this Saturday, 9 a.m. Central. EggersCapital.com. We'll talk to you soon.